Hey folks, David Frost, My Strategic Forecast. You're here for another episode of Common Sense Market Analysis. Today's Friday, June 12, 2015. Looking at a daily chart of the SPY, or the Spider. And what we had today was another Friday down day. What was interesting, and I've mentioned this before, but the band keeps on playing. Last year, in 2014, most of the Fridays were up days, just minus a few, a handful. Today, or this year, many of the Fridays are down days. It's the exact mirror image of last year. I just think it's interesting to note, but we weren't surprised, right? What happened was, last night we discussed that the market was into some resistance and that it would probably need to pull back, and we knew what numbers that it needed to jump over to go higher, and we knew where the pullback would be, right? We had this green line in here, and although that wasn't a by the market green line, it was certainly a level of support that we thought the market would go to. So let's go to the hourly chart and just see it real quick. So basically what we had was we had a down move right into the first level of support, 210.40. Well, this was the second level. We jumped over the first at 210.98. So when we jump over the first, we look right to the second. Pierced through it. The next candle had a big sell, went to the 209.80, and then we bounced up right back into the underside of the previous support, which is now resistance, 210.40, and then we just bounced around all day in between, and that's normal behavior. So if we got below and closed an hour below the 209.80, then we would have done the same routine, most likely in between these two, right? In between this 209.37 and the green line 209.80. And the reason is because the market just goes to the next level of resistance or support, and then it establishes a new range. And the reason why I would have been confident to buy this level if you're an intraday trader is because this was a gap window. So at this low would have been a wonderful, wonderful support, okay? And you could have bought that, and then if the market continued lower, this would have been your next spot, 208.50. Okay, so we got that picture. Let's go over to the E-mini and just translate the information back over there. So hourly chart again, and you can see what happened here. The 2084, whether it's 2083 or 2085, doesn't really matter. You can see how important this price level is. Prior support, breakout, right? And we're back into that same level. What do I think is going to happen next week? Well, what's interesting is next week you have an important span of time, and I talked about this last night. I talked about short-term cycles converging, or I thought that we would have a little bit of downward pressure in the market. And I think that could carry through, let's call it Monday, Tuesday. And what's interesting, maybe even into Wednesday, what's interesting is Tuesday and Wednesday is another one of the phony Fed meetings where they're going to have a canned announcement. And the likely scenario is this. The market will be nervous ahead of the Fed. They're going to raise interest rates. The boogeyman's coming, all that stuff. And then they come out with their announcement. And then we parse the words. We look for one word or one phrase or one letter, one syllable, one dotted I, crossed T that's different from the rest, from the other reports. And then we harp on it for about a day. And then we'll see what happens. But who knows, folks? I mean, the Fed is a joke. They have no business in the market, but they are in the market. Despite what anybody wants to believe, it is what it is. The market believes there's a put underneath with the Fed there. Sooner or later, the market will cease to believe that the Fed has a put under the market. And when that happens, the market will have a liquidity crunch. And that's just the way it works. That's the way it is. I want to mention one more thing because I know a lot of folks were watching Twitter today. I got a few emails on Twitter, and let's just talk about what happened for a second because it's a good lesson in terms of Wall Street, stocks, companies, CEOs, the media, and analysts. So check this out. So last night, Twitter comes out and says, our CEO, Dick Costolo, is going to step down, and the one of the founders is taking back over, whoever it is, Jack Dorsey, I don't know him. It doesn't matter. The point is that here's what happened. So the market was, let's go to the daily chart, and I'm going to show you what the market was doing. Okay, the market was telling Twitter by this action here, by this money flow or lack of money flow, the market is telling Twitter, we don't like it. We don't like what you're doing. We don't like the revenue projections. We don't like your CEO. We don't like whatever we don't like it. So you need to make a change. And they did the same thing to Facebook back when Facebook came public. Just let's go back there and see. Okay, I'll go to the long-term chart. We're not going to spend a lot of time on Facebook, but we're going to just see what happens. So Facebook comes public and sells off all the way back down to like $17, and then it took off. And why did it go back down to $17? Because the market was letting Facebook know, and Mark Zuckerberg know, and all the other executives over there know that they're not in charge. The market's in charge. Okay, and when the market doesn't like something, it's going to tell you. And the market was telling Twitter, let's go back to Twitter, okay? The market was telling Twitter over here, we don't like it. So all of a sudden yesterday, you had a reaction off the news of the CEO leaving, okay? And here's what happened. So the CEO announces he's leaving, and then we have a spike up yesterday over here. Let's look at the 10-minute again. And it was spiked actually over $40 and then proceeded to pull back, and that's normal. And that there's nothing that said this couldn't have based for a while and then went back up, but it didn't. What it did was it based for a while and went back down. And what that's telling you is that the market didn't even like that. And here's what they didn't like. Dick Costolo comes out and says, I'm leaving. The new guy and the conference call yesterday and today and all this stuff, they say our strategy's the same, everything's on target, blah, blah, blah. Well, the market doesn't want to hear that. They don't get it. And it's not even true. They're just not telling you the truth. They're just telling you what they want to tell you. If Dick Costolo is leaving, believe me, the new CEO, whoever that's going to be ultimately, is going to come in with his own strategy. That's just the way it works. There's no CEO in the world that's going to come in and continue somebody else's strategy. It doesn't work like that. If the strategy was working, the other guy wouldn't have left. So when the new CEO comes in, then the market will get another chance to give Twitter another look. But until they see who that is, or until they have some definitive news of what's going on over there, there's going to be pressure on Twitter. And it's that simple. It's not the Twitter plans. It's not the revenue. It's not the CEO right now. What it is it's the market telling Twitter, we don't like it. Make a change. And that's what they're going to have to do. And once they do, Twitter will rally. And that's the way it is. Can you buy Twitter here, be a kind of a dumpster diver and buy it? You could. Where would you put your stop? You'd have to, below 35. 35 is the waterline. I think that's a fair waterline. Above 35, you can stay in it. Below 35, I wouldn't want to be there. It could easily go to 32 or 31. Who wants to be there? All right, I'm sorry to spend so much time on Twitter, but I just wanted to make mention that this wasn't forced buying, institutional buying, or anything like that yesterday. This was most likely short covering. And then the shorts, and then they realize nothing's happening, and then right back to down to earth. And where do we finish today? Up 7 cents. Nice day. So, all right, let's move on. Let's just go right back to the S&P, because I just want to reiterate and make sure that we've got what we've got here. Okay? I don't know why. Here we go. Okay, so Monday, Tuesday, I think that we're going to see some more downward pressure in the market. I don't know about Monday and Tuesday. I'm just saying in that time frame. So early next week, we should see more downward pressure. And where's that going to be? Well, your first order of business is 209.37. And then your second order of business is to fill this gap right down here at 208.50. And you could possibly go down to double bottom. But I'm not sure that's going to happen. So let's see how it plays out. And let me give you the like numbers on the ES contract here. I'm going to flip over to the daily chart, and then we'll move on to other markets. Okay, so you came right into the 2084. Look where you finished. You finished at 2085. Isn't that ironic? That's the same 2085 from last month. I shouldn't have changed it, even though the calculation came $1 lower. I should have kept it at 2085. It's a round number. It works. Then you have 2078, but it's really close by, and if this doesn't hold, I got to believe that, we're at least going to go down here, 2072 or 3, and then you go to double bottom, but that's where we are. Here's that trend line that I couldn't find last night. This is what I was looking for. So, this is still going to hold true to some extent. I don't remember where exactly I drew it in for. The other night it looked pretty good, though. Well, either way, maybe it wasn't a good trend line. But anyway, after that, as long as you hold 208 next week, and here's the bottom line, this is what you need to know. As long as you hold 208 next week, then the market's still going to remain in a bullish position until 208's broken. And that's the bottom line, okay? So we have a low, higher low, and as long as we maintain that higher low, we're going to have higher prices. It's that simple, folks. Forget about the noise. That's the way it is. Okay, let's go over to gold. Thought it was interesting today. We had a tiny little push at the end of the day in gold, and it's very simple. I drew another line in the chart that you're going to notice here. And today gold pushed up a little bit, even though it was down earlier. But it tried to rally a little bit and finish above the moving averages, at least in the intraday chart. But here's the deal, okay? What I've done is I'm going to go back to a longer term chart, daily chart, and I'm going to draw. I drew this in for you. Let me explain what it is. This big red line is your line in the sand, okay? If you begin to close hourly below that level, okay, where this pivot low is, where these pivot lows are, okay, if you close below 1174, all right, hourly, and then further that daily, then you're probably going to have to see 1155 come into play. That's $20, and maybe that's okay if you're long, and maybe it's not. But I'm just letting you know that if you break 1174 convincingly, you can take the ride down to 1155. Now, I don't know if we go lower than that. I don't have anything that definitively would tell me that. But what I do have is that below 1174 is 1155, and that's good enough. As long as we stay above 1174, I still think we're going to see higher prices, and that's the way it is. So right now we're in no man's land, and we've got to get above the 1185 level, first order of business, in order to kind of take a stair step higher. Until that happens, we're in no man's land, and we'll just play it one day at a time. We'll see what happens next week, but that's where we are in the gold market. Oil, that's USO. We don't want that. We want the oil. Okay, so here's the crude contract. And what I thought was interesting also is, you know what? I had that on another chart. 59.75. Oh, that was on the July. Yeah, this is the same contract. Pardon me, folks. I'm just trying to figure out why I have a line in another chart, another screen, and not on this one. 59.75. I'm sure that I told you guys the 59.75, and I don't know why it's not coming out in this chart, but it's important that it's in there, and I'm going to show you why in a second. I remember talking about 59.75 here. Here we go. Okay, so now let me go intraday, and I'm going to show you why that was important. And you'll remember I talked about that. You go back to video a couple days ago. Look at this. This is a 10-minute chart, and this is 10:40 in the morning. And we hit the 59.75 and bounced off of it. It's interesting that these numbers, their calculations, and the numbers come into play as support and resistance over and over again until the market moves definitively away from them. But while the market is in and around those numbers, they continue to act as support and resistance. And I just look at this hourly chart. We bounced right off the number, and I don't know why this line wasn't in there today, but I know it was in there the other day. I know I talked about it. But here, this is a bullish pattern developing, and I would suggest that we're probably going to go further lower next week. And if we do, let's go to the daily chart. And, here we are. 58.70 is an important number. And then the bottom channel, which I don't know if we get there or not. But we'll see. If we do, that may be a good opportunity. But if we just base here and we came down to, let's say, 58.70, we could see another leg higher and move to the top of the channel. Right now, I can't tell you one way or the other because you're smack in the middle of the channel. There's no trade. There's no way that I can tell you which way it's going to go Monday or Tuesday because I just don't have it. What I can tell you is that the intraday, the hourly, and the intraday 10-minute chart is very bearish. Okay, so I would expect lower prices into Monday or Tuesday. while we work off some of this bearish condition here. And then we'll have to see what happens. But 58.70 should be wonderful support if we can get down there, and we'll see what happens. So I don't have anything other than that. Bond market today, the bond market was weaker a little bit. Let's go over to the TLT. And, what we said was we had this low here, 115.43. That was a spectacular trade. I'm still getting the emails. Thanks, folks. I appreciate the kind words. And then we gapped up and we went higher yesterday. And then we put in this doji candle, if you will, as somewhat of a topping tail on some volume. And then, and this is the hourly chart, so as it relates to other hourly candles. And now we're working off some of that overbought condition, and we're probably going to come back down to 117, maybe even 116.50. If you're not long the TLT, that would be an area that you could begin to get interested next week. 117, 116.50. If you hold 116.50 and begin to close hourly above that and then subsequent daily to that, then you should see higher prices. So that's where we are. You get another bite at the apple on the TLT if you're looking for that. So you're really looking for the market to correct down to maybe the 20-period moving average, and if it goes lower, it would come into this area right here, which is going to be a very, very good level of support. And that's the story. So if you don't come there, you could actually just continue higher, but I think you've got another day of downward pressure on the TLT just to work this off. This was a big shot higher. You'll typically take a shot higher, work some off, and then take another shot higher, right? A, B, C. There you go. The dollar was down slightly today. I still think the dollar has lower prices. I've been saying that for a while. Nothing's changed. There was no real change in activity in the dollar today telling us one thing or the other. It's the same thing from yesterday and the day before. It's basically putting in a sideways pattern here, and if it continues, then I think there's lower prices to be had, and the level I want to buy. Right down here, a little over 90, whatever that, anything in this neighborhood would be a wonderful buy. We'll have to see what happens, but that represents a retracement from the inverse head and shoulder on a monthly chart. For those of you that have been around for a while, you've seen me do that before. Let me bring it up. The chart's going to look a little messy because I've got a lot of stuff on there. But here it is. So this downsloping purple line, okay, really brings us into that neighborhood where I'm referring to. And, when you look at a monthly chart, when you get an engulfing candle like this, and then you start to put in some sideways months, that's setting up for more bearish behavior. That's not a bullish pattern. However, the trend is up on a long-term basis, but these monthly charts, right, take a long time to play out. They take months to play out. So it seems like, it takes forever, but in reality, each one of these candles is another month. So, here we have a spike up 1 month. Here's a second month, third month, fourth month. You could see another 2-3 months of this bleeding down or something like that. We'll have to see what happens. But, keep in mind, you can't trade off of a long-term chart like that. You just have to understand what the trend is on a long-term basis, help you make decisions on a shorter-term basis sometimes. Let's talk about Walmart. I know a lot of folks are interested in Walmart. Walmart's acting terrible. I get it. But let me show you where we are. Maybe it'll put some folks' mind at ease a little bit. What we've done here is on Walmart, we came into a couple of Fibonacci levels. We came into a 382 using one calculation, one low, and on a monthly basis. Oh, pardon me, that was the 382. And, here's what I'm looking at, right? So we came in, I didn't think we were going to get to the 382. I thought we were going to hold this big green up bar here, and we didn't. So therefore we came down, and once we broke this on a daily basis, this level here, then the 382 down here at 72.26, that acted more as a magnet. But look at all this support. Look at how many times the 72, let's just say 72.25 was defended. Here, 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 here. Well, will it be here? We'll see. Okay, you have an upsloping 50-period moving average. You're in between the 50 and the 20. You're into a 382 retrace. You've got a lot of chart support. And, we'll see. I think it'll hold. But if it doesn't, it's Walmart. It's not going to zero. Okay, I'm willing to hold it for a while, even if it comes down to the 50-period moving average. And even if it comes down to, this is going to be my last level of support. I'm not interested in seeing 60, but I don't know that I'll let it get to 66, but we'll see. I'm a little concerned. I don't like the action in Walmart. It just doesn't seem to be able to catch any bids, any buyers. But let the noise clear up. Let the middle of next week pass. Let the Fed meeting pass. And if it happens the way I think it's going to happen, I think we're going to get one more scare you dip in the market early next week. And I think we get one more rally up into July, and then we'll see what happens after that. But that's kind of in my mind. I don't have any technical reasons why what I said should be true. It's just the 25 years of watching this over and over again. It's not rocket science. I'm just saying that's what I believe is one of the likely scenarios, but I'm not going to trade off of that information. I'm just going to keep that in the back of my mind and let the numbers do the walking, and we'll just trade it accordingly. I think I'm going to leave it there tonight, folks. Have a great weekend. I'm David Frost, mystrategicforecast.com. Thanks for tuning in for another episode of Common Sense Market Analysis.